everyone, this is Demo Gonzalez of Heartwood Financial Services. Welcome to our latest market update and outlook. In these videos, what I try to do is bring you market relevant information that's going to impact you and your portfolio, but without all the hype and all the bias. So let's get right into it. All right, so let's get started with the asset class returns. When you look at the green, that's the year to date. The blue is the month to date for the month of April. As you can see, so far, pretty good year when you look at the green. And the blue is a little bit more mixed, but still not too shabby. We were up 1.5% for the large cap stocks. The small cap stocks took a pretty big step back this month. We saw that there was a lot of negative economic hits, which we'll talk a lot more about here in the next piece. With the small caps are very sensitive to what's been going on with the banks and the economy in general. Real estate kind of hung in there, actually surprisingly. But again, the champ for the month and for the year is developed international. The dollar has been kind of weak still, hasn't been going up, so it's still been going down a little bit. And again, the Europe economy is hanging in there pretty good. So the stock market has actually rewarded that area of the international stocks. Emerging markets, not as much, but still positive for the year. It was a little down for the month. Bonds have been doing pretty good. High yield and the U.S. fixed income have actually had already a pretty decent year. And we're not even halfway through the year yet. Commodities have been down. Part of the reason why inflation has been coming down is that the commodity prices, especially energy. But actually gold has been up, and it was up again a little bit for the month of April. So there's your asset class returns. Now let's get into what's been going on. So you know it's a good sign when you don't hear the news talk as much about inflation. And I bring it up every single time because it is the main driver to what the Fed is doing. And the Fed is the main driver to what the market and how it's reacting. Okay, so here's the latest. We had numbers for last month in April where it was only up 0.1%. Okay, so again, if you extrapolate that for a full year, that's a pretty low inflation rate. So that again brought the year over year number to 5%. Starting to feel a little bit better, still really high and way too high. And you can see the blue line here is the CPI. This has been coming down. Now, of course, the big news for the second week of May is we're going to have the next CPI report that will come out for April, which is going to be in May. So that hopefully will show the trend continuing. I do feel that that trend is going to continue to the downside. We'll get more into that in the outlook. All right, so let's get into what happened with the Fed. Now, they actually met in May, but I snuck this one in to the April update because it was early in May, May 3rd. And so here's what happened. The Fed raised rates again, 0.25%. And so now we're at 5 to 5.25. This is the highest that we've been in about 15 years. You got to go back all the way to pre-great financial crisis to see rates this high. And this is the short-term Fed funds rates. So what you're seeing happen is you're seeing the money markets and CD rates and things like that at banks also start to follow suit and pay very attractive yields. Now, the big thing is, what is the Fed going to do next? So this is why I named this one to pause or not to pause, borrowing from Shakespeare here a little bit. But I think what's going to happen is they're probably going to pause because I'll show you a little bit more in the outlook, what's going on with the data, with the economy. And so I feel like they're pretty close to the end. We might see one more, but I kind of doubt it. All right, the title of this is Another One Bites the Dust. Now, I'm not trying to be cavalier. It's actually a pretty serious situation. First Republic Bank failed a few weeks back. FDIC insurance took it over. This is like a little replay of what happened with Silicon Valley Bank. First Republic Bank is actually a little bit bigger even than Silicon Valley Bank. And it got sold off to JP Morgan. They were the highest bidder. So that's kind of how that works. And so what's happening here is you get these banks that have a huge proportion of clients that have more than the FDIC maximum. And when you have that, a lot of those folks get a little nervous when they see the stock price go down. They see the news, and it's kind of a self-fulfilling, a prophecy or a cycle in a way. And so that's what happened to First Republic Bank. There's some other banks out there that are kind of on the edge. Their stock prices have been very volatile. Some people are blaming short sellers that go in there and kind of predatory trades. Who knows? It's hard to say. But these other banks that have been having issues, which, by the way, they're also mostly out west, which makes you kind of wonder. But they're mostly have more diverse clientele and don't have the same percentage of non-FDIC covered deposits, which was a big deal. And so I just don't see this continuing to expand. Maybe there might be one or two more, but it does seem to be mostly contained. Of course, human behavior, you know how it is. People are going to make this a big deal, and it might take a little while for it to finally die down. So it's something to keep an eye on, but again, not to be startled or panicked about what happened. And of course, the last piece we have here is the debt ceiling limit is coming up soon. Janet Yellen just had a report come out saying that drop dead date of extraordinary measures, they run out right around June 1st. It's hard to say exactly if that's really the drop dead date, but it's a guess. And of course, if history is have a pattern here, we've seen that we always raise the debt limit. There's been some times like in 2011 where we pushed it to the very, very last date, and it actually went a little bit past, and there were some issues. The market had a little extra turmoil for about a week or so. The S&P downgraded our debt a little bit. So there were some ramifications to this, but again, they were very short term and it didn't last. And they will raise the debt ceiling again. Hopefully they can come to some consensus of what to do with spending and the debt limit and just, get something done here. If anything, what I see here is an opportunity for people that have a long-term view to maybe take advantage of some stressed out trades that could happen in the next week or two up to this date or right around this date. Because we will pass a debt ceiling. It's just a matter of time, and there could be a little stress till that happens. All right, now for the outlook, I want to frame the conversation as two opposing forces that are very powerful. They're going to have a big impact on the stock market, okay? On the one end, you have the Fed finally pausing. It looks like that is the course they're going to take, especially if you see the inflation numbers continue to go down. Heck, they might even have a little room to maybe even cut down the road. Not saying that's going to happen, but it could potentially happen if things get bad enough on the recession side. Now, this is a very powerful force because when the Fed at least stops raising rates or even cuts rates, it expands the ability for the stock market to go up, okay? Now, on the other side, we have recession, and we're going to talk about leading indicators, and you'll see how the probability of recession is very high. Now, what we don't know is how bad the recession is going to be. Most economists think it's going to be mild. I think it's maybe more in the mild to moderate camp. And I do feel like the market has priced a lot of that in already back in October when the market was down 22% at that point, and we've kind of come back a little bit since then. But it's hard to say because if it's a little bit worse than mild or moderate, we can maybe see a reassessing of that, okay? But I'll have to say, if that's happening, inflation is going to be coming down even faster, and the Fed will have the ability to cut. So you can kind of see how these two very powerful forces are also opposing. And so we'll see who wins here over the next year or so. I'm leaning a little bit more towards the pause, and we'll talk a little bit more about that here next. All right, so hang in here with me for a moment. I'm going to get my nerd on here a little bit. Because I'm going to talk a little bit about CPI forecasting. And this is one of the biggest parts of my thesis of why I think the pause is going to be more powerful than the recession. And it's because we're seeing inflation come down. So over here, this is the 2022 month-over-month numbers. Last year we ended at 7% in the CPI. Over here in the middle, we have so far what we've seen in 2023. Okay. And so obviously we haven't seen what's happened in April and beyond. I'm just copying over from last year. So that's why we're at 5% year over year. All right, follow me so far? And so on this third column, what I did is I said, all right, well, how long is it going to take till we get inflation back in a 2 handle or a 2% range? And so if I go with 0.2 for April, which would be around what we saw in March, another 0.2 in May, and somewhere around a 0.2 in June, because the economy, again, is going to be slowing down. So the more the economy slows down, the better the probability of inflation being down. And I also see the lagging owner's equivalent rent, all the housing stuff that's going to really start to kick in during the summer and lower inflation even more. So as you can see, by June, we could already be at 2.56% year over year. If the Fed sees that, they're definitely going to be done. It's going to be a pause. And we might even see cuts if the economy is showing a little bit more weakness than they anticipated. Okay, last thing before I get into the implications. I know this is a really busy chart, but I just want you to focus on this little red dot here. That's taking all these different leading indicators and creating an average, and it's kind of right in this spot, and it's in a declining quadrant. And so this little chart by Econ Pi, which I take a look at every month, shows that things are slowing down, almost in contraction territory. In the past, when the average has been in this zone, we are within 3 to 6 months of a recession. And that is probably going to be the case here as well. There are way too many leading indicators that are pointing us in that direction. But again, as we talked about a moment ago, we have the opposing force of the Fed pausing. And so what's going to be more powerful? I think it's going to be the Fed, but there's still a lot of negativity around the economy and potential earnings that can come from that. And so it's still a very sensitive time. Certainly don't want to stick your neck out too far in being aggressive in this market. All right, so it all boils down to the Heartwood implications on what this means to your portfolio. So I'll show you here what I've been doing with the Heartwood Financial Services portfolios. Stocks, I've been basically keeping neutral weighting overall to stocks versus bonds and others. And I've been reducing the small cap and financial stocks. I've been doing that over the last actual couple months. Adding a little bit more to the large cap, which is the more quality names, and specifically a little bit more towards growth, because when the economy is slowing down, it's a little harder to get growth, and so large cap growth tends to outperform a little bit. On the bond side, we're adding to high quality bonds, reducing more of those stressed out bonds, especially the ones that are associated with the banks, and continuing to reduce real estate. We've done most of that already. Keeping a small stake in real estate, because a lot of that has already been priced in. But again, there could still be a lot that can go on repricing, especially in that commercial real estate market due to what's been happening to the banks. All right. So that's in a quick nutshell. If you want a little bit more information, please feel free to reach out. Happy to get into more detail. But until we meet again, God bless.